The last 4 years in real estate have been a total roller coaster. In the wake of the pandemic, real estate exploded in both asset values, rents went through the roof, and then interest rates shot up in 2022, and it caused some major problems, especially in commercial real estate, but also in residential. So that sort of sets the stage for a conversation that I wanted to have today with Andrew Cushman. He's the founder of Vantage Point Acquisitions, a workforce housing investor with over 2,800 units in the Southeastern U.S. And Andrew was was proud to point out none of those units, none of those properties are in trouble. They're all paying distributions on time, and they're all doing great. So, Andrew, yeah, let's talk through how will real estate perform in the next decade compared to the last decade?
Yeah, that's the question we're all trying to figure out. And I would caution anybody against building or betting on any one particular outcome. We always want to talk in terms of probabilities. So what I'm going to say is what I see as the most probable outcome, but that doesn't mean that far different outcomes are zero probability, right? There are realistic chances that something far different could happen. And as you alluded to, the last 4 years were a complete anomaly. We had two insane up years, and then as markets always do, they corrected the excess. The last 2 years have been down. Multifamily pricing, depending on your market and asset, class A, B, C, whatever, is down 20 to 30% from the peak, which I would call the first quarter of 2022. But for anyone who's been around for a little while, the period I would say from 2012, we started buying in 2011, but the period from 2012 to 2022 was probably one of the best 10-year periods for commercial real estate and especially apartments in US history. Not only were we coming off a huge recession with incredibly low pricing, we had a growing economy, we had population growth, we had job growth, we had rising incomes. And if you bought in that first 5 years, you picked up properties at unbelievable prices. And so you were able to, value add was relatively easy. You could renovate, bump rents, increase your NOI, increase the value. And then on top of all of that, we had this huge tailwind of steadily declining interest rates, where the cost of debt got cheaper and cheaper and cheaper, which means that buyers and investors could pay more and more and more for these same assets and still have them cash flow because the debt kept getting cheaper. And so that was really as ideal of an arrangement that you could get for commercial real estate investing. And it really benefited all asset classes, maybe not retail quite as much, but in general, everyone benefited, and especially multifamily. Then you had the 4 year anomaly we just talked about, huge spike up, came right back down. And then now, part of what that spike has done, and then the fact that interest rates are still up significantly, is that has put a huge crimp on future development. So we're already in a long-term housing shortage, and depending on where you're getting the data, it's anywhere from 2 to 5 million units short, right? Meaning there's, 5 million more families looking for housing than there's housing available. And with interest rates where they are today, most builders are having a really difficult time getting new development to work, so they're not doing it. And the pipeline of new deliveries is actually drying up at a record pace, the fastest pace it's ever dried up. And so what that means is by the time we get to end of 2025 and into 2026, we're going to be back to not only just the regular shortage, but it's going to be exacerbated by the fact that we're not even going to have enough new deliveries just to keep up where we are. So the number one thing for real estate, but especially apartments, is just supply and demand. If there's more people looking for units than there are units available, then that means rents go up. So that's one of the big positives going forward is we are looking at a structural shortage of housing. And that's why if you look at rent forecasts for like 2026 and 2027, most of them are saying 5, 6% nationally. There's gonna be markets that exceed that, and there's gonna be some that don't meet that. But that's why we're predicting, or pretty much every forecast I see is for very high rent growth, which means increasing NOI and increasing valuations. So we are basically trying to acquire all we can in the next 12 to 18 months. With that said, uh, the previous 10-year period was probably the best we will ever see. The next 10 years will not, I do not expect to be as good as that. We're going to have to work a lot harder to get similar results and similar returns. The reason being is yes, we're going to have the population growth. Yes, we're expecting to have the rent growth and therefore the NOI growth, the net operating income growth. However, because of structural U.S. deficits and a host of macroeconomic factors, it is very unlikely that we're going to have that huge tailwind of declining interest rates again. As we're talking today, the 10-year Treasury, which is what most commercial loans are based off of, is floating somewhere around 4.4%. Historically, that's actually still low. But with, again, the deficits and the amount of Treasury issuance that the government has to give out in order just to stay afloat, it's, a lot of forecasts are calling for the 10-year to even get up to 6, 7%, or at least stay where it is. Very little expectation or economic reasons to expect it to be lower in the future. Now, will it oscillate a little bit? Could it touch 4 or 3.5 briefly? Yes, but long term, structurally, we're looking at higher rates. So if interest rates are higher, then that means the cost of debt is more expensive. Therefore, buyers and investors have to pay less for these properties and to come to work. And so what it all boils down to is, will the rent growth and resulting growth of income be enough to offset the most likely increasing cost of debt as we go forward? My base case is that it is probable that yes, that will be the case. I don't think it's going to get any easier to build. I think, again, labor is going to continue to go up, costs are going to still go up, insurance, all those things. So what all that boils down to is, yes, right now is a great opportunity to get in. Yes, I believe that we're about to enter another upcycle for commercial real estate, especially multifamily, but do not expect it to be as easy or profitable as the last 10-year cycle we just exited.
Oh man, I love how much you crammed into those few minutes. That's great. So I do have a follow-up question for you. You talked quite a bit about interest rates, and I've heard an argument made that as the federal government's debt balloons, I think the latest forecast from the CBO, the Congressional Budget Office, was that uh, within the next 10 years, we'll be at 117% debt to GDP ratio, and that may even be conservative. Um, so the argument goes that as the debt balloons upward, the government just won't be able to afford to keep interest rates high, and that they will have to, or at least not for very long at a time. So they will have to keep interest rates artificially low. And I'm just curious about your response or your thoughts on that argument.
That is true in that the government won't be able to afford the higher interest rates. The unfortunate faulty assumption behind that is that the government controls interest rates. The Federal Reserve does, in fact, control the federal funds rate, which is the overnight rate that when banks lend back and forth to each other, that's what that rate is. The Federal Reserve, and then there's most listeners have probably heard of the rate curve, and all that is it's like plotting out. Well, here's the rate today on the federal funds rate, which is like one day. Then there's a 4 week, and then there's the 2 year bond and the 5 year bond, the 7, the 10, the 30, all the way out. And what happens is if you take those interest rates and plot them on an Excel chart, the rate and then the term of the bond, it produces a curve that shows basically the summation of where financial markets expect interest rates to be in the future. If you look at that today, that goes up steadily as the further you go out. The government sets the front end of that, the overnight rate. And the further you get away from the overnight rate, meaning 5 years, 7 years, 10 years out, the less and less direct influence that they have. Because those rates, again, are determined by supply and demand. The Treasury does auctions and goes out to market and sells another 500 billion worth of bonds. And if there's no one there to buy them and there's no one there bidding on those bonds, well, then they have to drop the price. Well, what happens when they drop the price? Well, the yield goes up, right? So that's why the government, really has limited influence on those longer term rates. I mean, it doesn't matter who's in office. They can say, I want the Treasury at 3 or I want the Treasury at 7 on the 10-year. Good luck, right? You're talking about something like, oh gosh, I forget. It's like a 36 or $70 trillion bond market. It outweighs all of us. Now, with that said, there is one ace up the sleeve that the government has. It's not healthy, it's not good, and it'll cause long-term problems. But we already saw this happen during COVID, and we'll probably see it again. Is the Federal Reserve can go out and buy the bonds. So basically, it's like the government's taking money out of one pocket and putting it in the other, and that's called monetizing the debt. That is incredibly inflationary. They can do that to keep rates lower in the short term, but it will blow them up in the long term. So that'll be a sign that things are about to get really bad. But that is one unhealthy way that government, can directly influence longer rates.
That's great. Uh, mini macroeconomic lesson here. I love it. All right, Andrew, in 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
Well, let's see. We primarily help investors by trying to provide lower risk, stable, passive investments in apartments. And again, we're very much a niche. Like we're Class B to A minus, garden style, Southeast U.S. That's what we've been doing forever, and that's what we intend to keep doing. And then best way to connect with me is, you can go to our website, vpacq.com, short for Vantage Point Acquisitions. And there's a couple of tabs on there to connect with us. Also, I'm not on social media except LinkedIn. That is the one social media platform I'm on. And if you connect with me there, that actually is me posting and that is me commenting and replying. It's not a VA or a chatbot or AI. So that's a good way to connect as well.
Awesome. Well, Andrew, thank you so much for joining us today. And guys, if you enjoy these quick, focused conversations that we have, please rate and review the podcast. It makes a world of difference to us. And on that note, we will catch you next time.
All right. Thanks.
Want the cash flow appreciation and tax benefits of real estate without becoming a landlord? You've heard of REITs and real estate crowdfunding, but you probably don't know much about 5 other ways to invest passively in real estate. So we put together a free video course for you to show you how to consistently earn 15% plus returns from 5 lesser known hands-off ways to invest in real estate. And even more importantly, we'll keep risk front and center in that whole discussion. Because really, what's the point of investing for high returns if you also take on high risk, right? So visit sparkrental.com/free to take our free course. Each video is snackable at 10 to 15 minutes long, and the entire course takes less time than watching a movie. Looking forward to chatting with you from within the course.